Hello, hello. Nice to see you all. My name is Radek Zaleski. I'm a senior partner at Netguru, the host of this Disruption Talk podcast, and with me is George Kailas from prospero.ai. Nice to meet you, George.
Thanks for having me on.
I like to do this straightforward, right? I'm a simple person, with simple needs. I know you can get really rich right now over the internet if you use the right tools, if you get the right information. I logged into Reddit, Wall Street Bets. Now I feel I can do it. What is Prospero? How it, might help achieve my goals?
Well, Prospero is pretty much the opposite of that. And I
Oh,
think, a lot of Wall Street bets. And I mean, I will say there is some really great due diligence on Reddit, but it's mixed in with a lot of really bad and really uninformed due diligence. And that's a problem. And it's a problem for everyday investors that really have no way of distinguishing between the two, because you do need a lot of training to distinguish between some of these things. And sometimes it's even hedge funds or that are planting some of these messages. And especially if you're behind an anonymous screen name, it's a lot easier to do that. So Prospero is a lot of seeing those problems over the many years, and problems I even had as an individual investor myself, problems I had when I worked on the buy side of the stock market, which I did. I worked at my first hedge fund when I was 17. I actually taught myself accounting to get that job. So I've been in it for a while. And even with that kind of training, I saw these problems. So a
okay.
lot of what Prospero is doing is working on that problem of properly vetting information so we know that it's good. How do we do that? The main thing that we focus on is visualizing where institutions are making bets, primarily in the options markets. We have other supporting signals, but we want to make that just really easy for people to grasp and apply quickly. And one of the things that we focused on, and Netguru has helped us in launching our app, is we refresh every 3 minutes. So people can get a live look at where institutions are making their bets. And that's the best information an everyday investor can get, because that's the information that's hardest to access. And we make it really simple for them to understand that. And I think that's a huge differentiator compared to most other things that are out there.
But, right, George, but this sounds really boring. I want to get rich very quickly. I read, over the internet that there is a magic sauce somewhere, like these guys have these algorithms, and if I just do this or do that, follow the right, accounts, maybe on Telegram, things will get better for me. This is what I hear every day, right? And how it is even possible to get all of this information. Well, what's the magic in it? The information that you've mentioned from the market, and to present them in a efficient way.
So one of the most important lessons that I learned, and I was always someone that was, I was a smart person from when I was very young, and I was very, obviously I started on Wall Street young, and my first boss out of college, very successful guy, sits me down after I ask him a lot of questions, and he says, "George, I feel like you're looking for shortcuts." And he looks me in the eye and he says, "There are no shortcuts."
Yeah.
And I think that is a very, very important lesson. Now, what I can happily tell you about Prospero is we've tried to create a very short learning curve to getting very important information. But, the magic and the example that I always give is it's just like all of these startups, anything, a lot of them haven't even raised or sniffed $100 million total in
Yeah.
capital raise. And Bridgewater, places like Renaissance Technologies, they could lose $100 million in a day and barely bat an eye.
Mm.
And the top 5 banks spend about $41 billion annually in just alternative data and related technology. So that's even a data barrier that these companies have. Not even if they had the same tech, they're behind these large institutions on data. So unfortunately, what most of that is snake oil. And it's just like
Okay.
promises being sold that they can't deliver on. And you know what? It's even, I heard you talk about Telegram. It's even worse in crypto. And like crypto is something that, I think long term, actually, I would say more blockchain long term is amazing technology. It's going to be a huge part of our future. But that being said, individual cryptocurrencies have an immense amount of risk, because you can't even see what Prospero focuses on is you can't see where whales are making their levered bets. You can't see that. There's no clearinghouse like we have an options clearinghouse in the stock market. So you are really just betting. whether people are making their bets. They could be setting traps for you all the time. So that's why it's just so important to do what we're doing and focus on tools like what we're doing, which is, what are the major players doing? Because you can't beat the major players, and anyone telling you that is just telling you something that is easy when it's not easy. There are no shortcuts, but shorter learning curves like we have at Prospero and other great products. But you really have to focus on understanding what the big players are doing. And I always say, like, if you're in the market, you're up against giants and robots and giant robots, and you're off trying to walk in their shadow, then fight them, because if you fight them, you're going to get stepped on.
Yeah. So that's a really interesting segue to the stuff I wanted to ask you about. So I am around 40 years old, and I remember the first time I have created my checking account. The person who was my account manager at my bank said to me, you can invest money in different funds, but it's complicated. I will be your guide. And then the process of buying such funds was pretty much, maybe not complicated, but I had to go to a branch, sign something, there was intermediaries, all of that stuff. Later, it became part of my ability to use my digital banking solution to do that. But still, it took time to change all of those things. And right now, I can do it via my mobile banking, which is even easier. But on the other side, the whole retail investor ecosystem changed. You have all of those apps, ecosystems, communities that allow you to bet a lot of money almost immediately on different things, right? Is it crypto, options, or whatnot? So my question is, as a clear person who is in this market, what's your opinion on this trend? Like, what are the chances? What are the pitfalls?
I think it's a scary trend. I think it's definitely a scary trend, especially in when you're talking about, like, in America, there's all of this like gambling that has started to happen too, like literal gambling, and that's like associated. I read an article recently of like actually tying, things like options betting and gambling together, because it is so easy and it doesn't feel like real money until it's gone. And it's just, it feels like a game when you're making money. And I've been there. I've been there where I've gone on runs and it's just like, oh, and you're just like making trades, and then all of a sudden it goes wrong and you're just like, oh, it's real money when it's gone. It just feels like fun and games when you're making it, or at least you're not losing money. And it's a very scary trend. But one of the things that I say to retail investors that's pretty funny is, like, there's an unfair game on Wall Street. But I mean, the analogy that I always make is, like, I don't see anyone complaining about people flying first class. And it's a similar thing with stocks. It's like, nobody promised you fairness on airplanes. Nobody promised you fairness in the stock market. And a lot of people's trades get transported in different ways. And that's like, things like payment for order flow, which I don't love, especially when people aren't transparent about it. But we accept these unfair realities all the time. But, I think the most important thing, and like the funny thing I kind of say back to retail investors all the time in terms of like American securities laws, like the one that I see, like kind of broken in my mind, more than anything, is some of these brokers that don't properly vet options traders. You're supposed to be vetted a lot more seriously than a lot of these brokers do. In theory, they like ask you questions, but they're supposed to have like, they're supposed to do some degree of digging that you're not lying on the questions and you're just basically like being trusted. It actually reminds me of back in the bad mortgage days, there were things called stated income loans, where you could just put your income down and they didn't check it. And like in some of these systems, you could actually put your income down and you were rejected. You could put a different number in and get accepted. It would just be like, it would even say like a leading question to you, like, that's not enough income to qualify for this loan. And then you could just put another thing. And yeah, it reminds me of that. And it's just like, I think that's the real tragedy of it, because unfortunately, I think a lot of people want more excitement in their lives. And especially as we become more isolated from other people and in our phones, it becomes easier to get addicted to these things. And there really should be more onus on governing bodies to protect people from this, because I think too many people lose their fortunes.
Right, because how I see this, there are two things here, right? One is this, let's say, gambling / entertainment part of it, excitement, right? It can be exciting, it can be fun, right? And technology empowers that. But on the other side, there is like democratization of investment market, right? And these tools also allow maybe people like me to trade with more things quicker than I had in the past, which I think it is a good thing, right? But mixed with entertainment, as I mentioned, gambling, maybe some shady patterns, this can be problematic, right?
Yeah, no, I mean, I think there's things like option spreads that Robinhood, like honestly, like I think Robinhood has a great interface for making option spreads easy. And I think making that easy for people if they have the proper experience is a fantastic thing because it can be very like if you really understand what you're doing, setting up option spreads are a great thing. But there's tons of articles of people like losing fortunes because there is a lot of risk and a lot of people don't properly understand it. And the other really important thing, kind of back to where we started on Wall Street Bets, is everybody talks about investing. If you looked on the internet, you'd think that 80% of people did well in investing because everybody only reports their wins.
Yeah.
But the numbers say over 70% of DIY investors, do-it-yourself investors, lose. So, you see those numbers and you're just like, well, if that many people lose, and I've heard stats that 90% of options traders lose, although that's like, that's more of something that just gets like repeated. I haven't found a source on that, but regardless, there's a good Financial Times source on that other number, which is enough and kind of encompasses everything. And that's a real problem. And it's great that it opens up. I do think investing should be accessible, and I do think more and more people should have tools that enable them to have access. The access is really important,
Right.
but there is not enough done to control that, to make sure the right people are getting access, that have the right training, because it just kind of goes back to another theme that we're talking about, where it's just like a lot of people want it to be easy. And you can't just have someone like in their first couple months of investing starting to trade options. That's a recipe for disaster.
Where do you fit in as Prospero in this whole puzzle, right? On one side, you have those, let's say, not really easy to grasp information systems, maybe privileged information in the past only to certain professionals. Maybe on the other side of the spectrum, you have a bit of a YOLO trading, on social media groups. And then there's Prospero. How do you navigate this puzzle?
So I think it's important in life to meet people where they are. And I think there's kind of this polarization in investing. There's, the people that just want it to be easy and are just trading like meme stocks or whatever. And that, it's easy until it isn't and you lose a bunch of money. And then you have, the complete other side of people like, kind of the stodgy old investors that are just like, oh, you need to read all the 10 Qs and study PE ratios and everything like that. And that to me seems like a very daunting task for people because there's so much terminology meant to isolate people. And Prospero was meant to, get closer to that easy end while bringing a lot of fundamentals. And, the one thing that we always say is that we want to teach people to fish. We don't want to, because even a passive investing instrument, as much as I say, like, if you don't have time, like Vanguard total return, low fees, that's a great thing to do. I tell a lot of people, I educate a lot of people in investments. And some people, if I think that they don't really want to put in the work, I'll just be like, I really do think a passive investment vehicle is better for you. It's better risk. These things are proven to work. And like, you can put in the work and you could become a great investor. But if you don't want to put in that work, it's not. So you do have to put in some work. But Prospero just wants to make the concepts that more accessible and wants to make it easier to track. Like two of our most important metrics are just called upside and downside. And one thing that I always tell the people, I just like, look at it. I was like, if the downside's higher than the upside, it's probably not a good investment, probably not a good investment, right? And that's just like, there's a lot that goes into making those signals, but that's, part of how we want to meet people in the middle. Just be like little bite-sized things where you can be informed, you can get a lot of information about like, how many institutions or the extent they're betting, for or against the stock in the long-term options markets, which is like one of the things that really underlie those upside and downside metrics. So yeah, we want to meet people in the middle, a lot closer to easy, but it's a theme that we talked about. Like nothing's that easy. And if you learn a little bit, Prospero is meant to say, hey, if you spend, some hours learning how this works, you will be way better than if you didn't learn this and you're kind of flying blind and just looking at social media or whatever. It can enhance that. Like you could take an idea that you see on Reddit, see if Prospero agrees that it's a good idea, and right there you've done way more than if you're just grabbing the idea and not checking any other sources.
Every year I'm thinking about myself. Now it's time. I'm going to invest. Like think about this. Like what should I buy? Which stocks? What type of equities? And then I try to do things that you've mentioned, like read the reports, read respected analysts, and then it's like I don't really get it, like too much, right? And then on the other side, sometimes you have this pop investment advice, like some examples, right? AI is coming, buy chips, right? Buy chips companies, go. No, for sure it will be great, right? Maybe, but sounds really maybe too easy, right? So how I understand, if I follow Prospero and learn about your systems, then I might be informed about what should I do in a concise manner, efficient manner, correct?
Absolutely. And I think you said a lot of interesting things there that I want to kind of respond to in order. I think, yes, there is a huge problem of like not only the language, but to be perfectly frank, as someone that was on Wall Street and off it, there's sometimes incentives. Sometimes investment banks are pushing certain stocks and they'll have their analysts, write more favorable opinions. So not only do you have the barrier of like, it's very hard to understand the terminology and how to use it and just like a lot of material through. There's also the case of there's also like a very important trust barrier that I think is valid. Like if any investor ever tells me like I don't trust the institutions, I can't really argue with that. Like that's why we try to like abstract like and just be like, well, we kind of amalgamate everything that they're doing. But another thing that I think is important that you said is like some of the best retail investors, traders that I know really just focus on one company or one index and really get to know it. And that's how they handle the problem that you're talking about. And they do very well, just like, figuring out when it's at a bottom, when it's at a top, because if you study the patterns of one or two stocks or indexes very well, you can get to know that. But I think that, yes, what you said about Prospero, and it's like, it's a very interesting kind of story about how we're built around options numbers, right? And the chip story. And I'll tell you a great story about Warren Buffett. And I came up as a value investor. When I first came up like 20 years ago, there was a hard no against tech stocks. And they said, you don't invest in tech stocks because you do not know how much of the growth is built into the price already. And that's what value investors said, because they had these high PEs and they just like, and the funny like tangible Buffett story where at one point Bezos went to Buffett and offered him like a discounted, share price. And they sat down and they met, and Buffett was basically like, these growth multiples are insane. Like I can't pay for them. I appreciate your discount, but I don't agree with the market price. So like the discount doesn't make any sense to me. And he'll say that was one of his big misses. And now and at that time he didn't invest in tech. But eventually he evolved and said he started investing in tech because now that's a part of it. But I give that intro to chips because it's very hard. People say just invest in chips. But there's a crazy, like I always like to tell this story about NVIDIA because their last 2 quarters are the best 2 quarters I've ever seen any company have. And they're huge and they grew at 236% year over year. But the crazy thing about that is they were down on that report because their CEO, Jensen Huang, gave some concerning data on China and demand with, kind of tensions between US and China. And the stock was down that day, and that just shows the dichotomy of what we're talking about. Like, you can even have the best quarter I've ever seen, and to put that in perspective and to go back to Amazon, Amazon's best report in the last 15 years, like one of the best growth stories of our time, 59% increase. So we're talking about a quarter as good as that quarter. But the market is just so that they're not sure if AI chips, things like that, are overpriced. So that's not good throwaway advice. Just because you don't know if it's appropriately priced, if it's not, if it has a lot. Like, everyone could agree that Nvidia is an amazing company, but is it priced appropriately is a much more difficult question. And actually, like, there's a like, actually, my last newsletter, we actually saw, we have two main things. We have net option sentiment, and then we have upside, downside that I mentioned. Those are the main things that track, net option sentiment in the short-term options market, and that just basically crunches like the bets for and against together. Upside and downside separates it out. Anyway, Nvidia was like 67 on our scale, which is not very high on the upside side, because there was some understandable hesitation with that value. And we actually just saw it go up on April 24th. It went from like 70 to 87. And that was before, 2 weeks that it went up 100 points. So I say all that to say, like, what's the important data there? It's very hard for us to argue. Like, I could make a case if it's overvalued or undervalued, but at the end of the day, that's why we lean on institutions, because almost all at the same time, an overwhelming number of them moved that upside. So they started to bet on Nvidia long term. They started to take a much more definitive bet on it. And that's, I think, the most important data point, because individuals, they can debate online all day, but in our estimation, what really matters is where the institutions are putting their money, not even what they're saying.
George, all of this is very interesting, I must say, but pardon my French, but I'm a really dumb person. And you used a lot of complicated language. If I log into an app like a Prospero, will I be able to see the things that you just mentioned on trends or on visuals? Does it work like that, or?
Yes, we like to kind of peel back the onion, right? So when you go in, you'll be able to see like the upside and downside rating, as well as net option sentiment. You'll get to see the trends. You can click on any of the metrics, and it'll give you a little story about a little bit about what it is, how to use it, and then you can dive deeper. We also have a newsletter that's up to
instead of us having such a conversation about like, this might be overpriced, but institutions are putting their money in, take a look at this, maybe this. Instead of this conversation, I can log into the app and it will kind of try to show me all of those things in a clear manner. Do I get this right?
Absolutely. And it was more in like story form, where you get like the information in little bits at a time. And yeah, like, well, also the other thing I was going to say is that we also have a newsletter. When people sign up for the app, we also put them on a newsletter. And so basically, one of the things that happens is we give tangible examples like we're talking about. So even if you log into the app and you're like, I'm still a little confused, you'll get a newsletter that says like, hey, this is what we're looking at. This is how we're reading the signals. And, we tell more of a story form there of how we form our opinions on stocks using the signals.
Thanks for the explanation. Now into even more dumb questions. I read over the internet, NVIDIA AI, but all of those cool new things, they can replace humans, and they're pretty good at reading through unstructured data, and out of those data trying to provide insights or trends. Now my question is it possible that in this whole retail investment ecosystem, you could apply some of those new generative AI, large language models systems in a way like read the reports or use the systems like Prospero and then give me tips and they bet on something? Is it foreseeable in the future? Is it even potentially real?
Yeah, that's something that we're very big on quality control, and that's in our pipeline. Probably in the next few years. But one of the big issues that I would say, especially in financial information, and we've even seen this in the legal field, where people have used ChatGPT and ended up like citing fake cases and things like that. And I think that's a big thing that we have to tackle, because these generative AI systems are not built to be accurate. They're built to engage you with as little compute used as possible, as little cost, right? So for us, where we've spent, you kind of work with us on our latest version, but we actually had a version before this and two versions before this that are not even official, because they never saw the light of day, because we didn't think the results are good enough. And I think that's a big thing with finance that I think is very important, and why we're careful, both in anything we roll out, but with generative AI, because it's so important. And one of the things that I kind of tell people on social media sometimes when they're like reporting company numbers or whatever, and I go look and I see something different, I'm just like, if you're just trying to get a report on the company, you should really read the SEC sources, because it's just like knowing you have accurate information is, you don't want to build a castle on a swamp. And you could be building like a castle on a swamp, and then making many renovations and not even knowing the original like data that you got was bad. And that's just like really hard, especially when if I was just speculating and saying chat GPT like might be, but like there's even stats that are saying that like humans are making chat GPT dumber and like less accurate.
Totally. Once you understand that this is prediction model, and based on previous inputs, then you have this aha moment, like, okay, so how can I debug it, right? How can I ask it for a reason, and it can't, right? So this is a huge risk that you take this, let's say, some kind of a data from analysts, put a prompt, whatever system, and give me ideas how should I invest. And the ideas might sound smart, and they might look like they're based on the real data, but you cannot debug it, right? You cannot tell if it's true. So this is how I see the risk here. Yeah.
You don't know if the recommendations are good. You don't even know if they're pulling the right analyst information. That like there's tons of problems, and like that's why like you're writing a little email or a post or whatever, and the stakes are a lot lower. But like if your money's on the line, like I certainly don't want to put my money on the line for something known to give inaccurate information. That's
right.
Vetting is everything, and that's to tie it together. It's the same problem with social media as Chat GPT. Right? Yeah. You don't know if it's been vetted. You don't know how accurate it is. And the accuracy of the information is so much more important, because you can't be drawing conclusions on information that you don't know is accurate.
100% sure. One of the things I remember from the last, around 10 years when we are on the market building software, is that I would say each year there is a new company coming to us, or a new entrepreneur with a request. Can we build some kind of a system that takes data and predicts stocks? Like this is like evergreen. And it's funny, but also it's not funny, because the technology goes, but it is better each year, right? And comparing to what you could do like 10 years ago versus right now, probably the outcomes of those things can be much better in terms of how you perceive them. Like, oh, this talks to me, it aggregates a lot of data, it gives me like real recommendations, like it draws charts. But then again, my thinking is it like 10 years ago or maybe 20 years ago or right now? I wouldn't bet on those advices, right? This would be uninformed decision, basically betting or gambling, right? And how I understand Prospero, the difference is that you are presenting like a vetted information based on a vetted sources in a approachable manner, but this is not a recommendation, just information, correct? That's the difference.
Yeah, I think so. I think I've got a lot to say on that subject, and people actually love when I share this, because I've actually been working on the underlying technology for Prospero for about 13 years. And I did AI as a service. I got into AI very early, 13 years ago, and I was helping institutions, advising, predicting on predictive models and building them out. Yeah. And about I think it was like probably like about halfway through, I probably had my worst. I had some great projects, but I had my worst project where I actually found out a little too late. We had great back testing on these models. We were doing a project for one of the largest asset managers in the world. And when we finally presented these stock results for them to look at, it wasn't until a few weeks in that I realized of the 10 picks that I gave them, that 7 of them were biotech stocks. Because actually, I was trying to predict stocks that had the highest chance of going up over the next quarter. And in asking that, you're generally, the market is generally bullish. And so stocks generally go up. So what the models were actually predicting was volatility, right? Biotech stocks are the most volatile, and it happened to be a particularly bad month. We did horribly, but it's just like I was working on that model for those models for at least 3 years. The back testing was amazing. We had some good live testing, but I didn't know a fundamental thing about how it worked. So I partially why I tell the story is, we've over a long period of time, we've learned these hard lessons. And, we program defensively, we learn them, we apply them, we learn how to get better. But now not only is it vetted, and not only have we done projects for some of the largest institutions in the world, and we've been very competitive in head-to-head competitions with one of the largest banks in the world. So there's serious technology behind it, but there's also experience, improvement, and before I even we're about 5 years in on Prospero, and we beat my newsletter picks beat the market by about 52% in 2022, about 47 in 2023. And in 2024, we're up, over 90% on the market on an annualized basis. So, that's what I always say. There's back testing, and then there's live testing. And I think that we vetted it. We vetted the sources. We've worked on the models. This is 13 years in the making. Yeah. But I think that it's also really important. And even if people, quote performance, what we also do is we tag everything. It's time-stamped on our Substack. So anyone can go back and see exactly when we made the picks, what they were. And that's what I would encourage beyond, because a lot of people talk about back testing or this or that. Yeah. But if they're not willing to actually show you the data, who cares what they say? And that's an important thing that we do, that I think, it should be part of any vetting process, where it's before you take any information from anyone, we're talking about accuracy. You should make sure that not only, that there's numbers, but that there's an easy way to verify that, how those numbers existed or anything like that. And at the very least, even if you're using tools, you should get good at vetting the tools, where it's actually a process where you just don't go with whatever they say. Because to your point, a lot of people are pretending like they have magic, but it doesn't really stand up to much scrutiny. They'll mainly just talk about back testing. And if they're only talking about back testing, you could be buying something that could take a huge fall, like I did in my major project, one of my biggest lessons in predictive modeling.
So, George, we are close to the end. To all listeners, if you are enjoying the talk right now, watching this live, you can ask us questions, and in the comment sections, we will try to answer them. If not, you can always, I hope, reach out to George on LinkedIn or Twitter, or sign up to his newsletter, and maybe contact with him directly if you're interested in the topic. For the final question, George, I have a question that probably I shouldn't ask, because you should never ask for an investment advice, especially on a recorded call. But I would like you to ask for an advice how to start invest in 2024 in the market, where you have abundance of information, tools, access, everything. If I'm going to decide, okay, I'm going to start investing, what would be your tips for me? How should I start?
What I always say with people that are just starting, let's say you just have money in a bank, you invested, you should start off safe. You should start off putting a lot of your money in something like Vanguard Total Return or Schwab Dividend, SCHD. Get a good base, maybe 80 or 90% of your portfolio. If you want a little bit, if you like crypto, I always suggest Block, BLOK, because that's diversified blockchain. And not only do you have miners, and there's a crypto hedge fund in there, and you even have PayPal and Square and Mercado Libre, which is doing interesting things with the blockchain, and it's the Latin American Amazon. Have have a nice base that are safer things. Like I would even say like 40%, just to be very clear, 40% Vanguard total return, 40% Schwab dividend, reinvest dividends. Maybe if you're feeling risky, 10% block, and you're just holding it for a long time. And then, with the other 10%, that's where you can start messing around with stuff, not options. Start practicing, take longs, but do like solid longs that you like the thesis. We really like, stocks like Meta or, Eli Lilly, or even like CEG in the utility space right now, or FANG and energy. The cloud providers are always like, Microsoft, Google, Amazon. I have a hard time seeing them not doing very well over a 10-year time scale. Start with that. As you get more money, you can reinvest, some of your profits in, riskier assets again, until you're doing very well on your long and long short. I wouldn't recommend options, but, start dipping your toe in more riskier things while, you have a dividend base building and you have a really solid thing, because that's going to be the best way for you to actually secure your future. And the worst thing that you can ever do, like, yeah, you might see all your friends, and we talked about the stats here, talking about like making money or whatever. But the best thing that you can do is build yourself a base of profit and take risk with that base of profit. If you're going to take risk, don't take risk with, important savings that are going to hurt your life if you lose it.
Right. Thanks for the tips. I don't see the comments, so let's wrap it up. George, thank you very much. It was very insightful conversation, and good luck with launching Prospero to the larger audience.
Thank you very much.
Thanks. See you.